All right, ladies and gentlemen, thank you for joining us on episode 27 of Bullish. Remember, anything we discuss is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. I'm Sam Hardy. We've got Nick Stenger, producer O. KP is in the house. We are Stenger Family Office for the past 43 years. It's been our mission to deliver clarity and confidence to help secure your financial future. If you haven't already, be sure to like, subscribe, share the show. We got a Nick and Sam special today. We're looking forward to it. And before we jump into it, just want to give you a quick reminder. We've got Investor Day 2026 happening in October 2025, October 16th and 17th. Mark your calendars. We've got some great guests lined up, so be sure to mark the calendars there. Nicholas, did I miss anything?
I think you got it. And by the way, that was the fastest you've ever done the intro, and you kept me engaged the entire time. So great job.
Yeah, you said to keep it quick.
10 out of 10 on the intro.
Thank you. I appreciate it, buddy.
We got a crazy market going on.
Well, yeah, market is back to worrying about the tariffs. I just wanted to take a minute here. Obviously, Berkshire shareholder meeting here. Warren announced he's hanging up the jacket for good.
Were you surprised?
What a legend. No, I mean, how old is he now? 95, 96, something like that. So he's getting up there. He's fostered some
94
great
years
guys.
old.
Okay. So he's fostered some great guys coming up. He
Greg
lost
Abel.
Charlie a couple years ago. So
We love Charlie.
do you
Very
want to
fun.
know what his cumulative return is over the
Let's
last
hear it.
60 years?
Let's hear it.
5.5 million %.
Is that true?
Yeah.
Wow.
But it was on CNBC. So
That's wild.
yeah, S&P's only done 40,000%.
Now, have you watched the meeting yet? Did you watch the Berkshire meeting?
I did not watch it yet. Caught some clips. Did not watch the whole thing. Did you?
So I watched some of it. I'm going to watch the whole thing later this weekend. But one of the things that's being talked about potentially is under Greg Abel, now we could introduce a dividend coming into Berkshire and also maybe some buybacks. So maybe that's part of the reason they've been sitting on all this cash is they say, hey, our stock is cheap. Let's buy some back. And it could be an Apple scenario where Apple hasn't had a ton of innovation the past 5 years, but it's been okay because they bought all the stock back and it sent the stock up to record all-time highs. Could be something very similar with Berkshire. And obviously the other day it was down quite a bit on the news that Warren was going to retire. I don't think that was really the major driver. We go through these 5% corrections on it all the time. But here's the reality. Up until a couple days ago, Berkshire was up 20% for 2025. And 26% the past 12 years, while the S&P over the past 12 months now is up 8.5%. So that could be part of it. I think people are anticipating some really good financial engineering coming down the road.
Yeah, well, and I think too, to your point about the cash, it's $350 billion now. Didn't really see a lot of it deployed in the pullback that we saw earlier in the year. And we saw that stat the other day from, I think it was Unusual Whales or something put it out there that he literally owns 5% of the treasury bill market right now.
That's insane.
So
The
he's
short-term
taking
treasury
his-
market.
Yes.
Right.
Yeah, the bill market. So I think there's like 6 trillion total, and he owns like 275 billion of it, or something like that. So incredible numbers. He's clipping his 4.5% right now that he's getting. And to your point, maybe they obviously would have known this was coming. It's not like he dropped that surprise on him at the annual shareholder meeting. It was the first they heard about it. So getting ready for that. I think as we're talking about kind of free, risk-free money there, with the markets, we've got Fed decision. We're going to get comments today, the official decision tomorrow. Do you think we're going to get any rate cuts or?
No, I doubt it.
Yeah.
So the big question is, are we going to head into recession? Obviously, that's part of the title of this episode as well. And what we've been talking about on my show from week to week, are we going to go into a recession, right? And we keep saying this of the fact that we did technically have a recession in 2022. Nobody
Yes.
talked about it. Enber never called it.
If you look at real GDP, it was technically a recession.
Right. 2 declining quarters of real GDP.
Yeah.
Some economists say you have to couple that with a drop off in unemployment. And that's why we didn't have a recession in 2022. But I still think that it technically is a recession, right? It's not the '08 and '09 fallout that everybody thinks about when they hear that big scary R word. But the reality is we could slip into a very slight recession. Now, the media is going to jump all over this if it happens. They're already pre-warning people, hey, it looks like we're going into recession, which is a totally different narrative than what they told in 2022. So take that for what it is. You can make your own determinations why they haven't covered it the same way. But all we've had so far, we haven't had an official GDP print for the first quarter. All we've had is early estimates. There's
Yeah.
going to be a second estimate, a third estimate, and then the final reading in late June, I believe. So we still have a lot of time to figure out what's going to happen. By the way, if you want to blame first quarter going down 0.3% on the tariffs, tariffs didn't really even go into effect until April 1st. So you can't look at Q1 and on both sides of it say, oh, yeah, that was because of tariffs. If the tariffs are going to have a major, major impact, which some people have said they are, I think they're going to have a dampened impact than people think. That's not even going to show up till Q2, Q3.
Well, we've got till July 31st till the 90-day pause is completed. Obviously, there's talks about lots of deals going on. We haven't really seen a whole lot yet. I think Argentina is one. Vietnam's come to the table. That's why Nike's stock bounced back like it did earlier in the month, and a couple others. But I mean, this is all about China, right? I know you've hit on this on your show, but a good reminder that that's who the target of this all is.
Listen to this. Since you brought up Argentina, Argentina's stock market the past 5 years is up 315%. The S&P 500 is up 92%. 315%. So, look, I'm pretty bullish on Latin America. I haven't gone out and bought a ton of Latin America companies. We don't do it for clients. We buy the US companies that sell into those markets. ExxonMobil is obviously a classic example of that in Guyana. But look at Argentina. I think what's happening behind the scenes is there's an expectation that you could see some manufacturing actually move back to Latin America as opposed to the traditional move a factory from China to India. Now, Apple is already moving factories from China to India. They did it the first time. But I've talked to people on the ground in India. Part of the problem with India is they just don't have the same skilled labor that you have in China. So part of the reason that you've had this concentration in manufacturing in mainland China is because of the skilled labor. That's very hard to replicate, right? It's very hard to reproduce that. But if you've watched the videos now with AI, machine learning, and even robotics, and you look at these Optimus robots, you look at the robots in the Amazon warehouse, I think there's a good chance you could build automated warehouses all throughout Latin America and ship goods right from there without the necessity of the skilled labor from China. And who knows, maybe we're 5 years away from this. But I think the reality is there's a lot of exciting things coming on the AI side of things that isn't the traditional sense of Chat GPT, right? Chat GPT is just the tip of the iceberg, but underneath the water is all of the neat things that actually will be bringing back manufacturing to maybe South America.
Yeah, and to your point as well, I mean, like, is China really in trouble here? I
I
know
I think so.
we've seen some talks about them melting down the smaller, medium-sized companies, especially now that the de minimis rule is gone, everything's getting a tariff on it, coming out of there. It seems like they're kind of starting to struggle a little bit. What I mean, can we expect any retaliation there? What do you think?
Listen to this. Okay, here's a stat for you. So there's been 384 million people who have now left the CCP the past few years. Just in 2024 alone, you've had almost 100 million people leave. Now, China's a massive place, so it's not necessarily a rounding error, but it's still a huge number of people. Here's another stat for you. This goes back to, I know this is older data, but in the first 9 months of 2021, 15 million people quit the CCP. And so
Yeah.
I think boots on the ground, if you really had an understanding of what's going on, which we don't, we get very limited data from China. I think President Xi has a tremendous, tremendous problem on his hands. I've been saying this for 6, 7 years now. And that's why Chinese stocks, yes, they've had a pop this year in 2025. Chinese stocks are up 17% year to date, but still look at the past 5 years, down 11% the past 5 years. And those were coming off of COVID lows. Even Europe has performed better. Europe is up 61% the past 5 years. China has been literally the one of the worst performers on a country level, and it's supposedly the second biggest economy on earth.
Well, and I mean, when we had Dr. Siegel on last September, he even said the only reason I would buy China is because it was trading at like a 9 PE. It's a strict valuation play. It's a trade. It has nothing to do with the underlying fundamentals, really. So, clearly people don't like living under communism, which big shocker, I guess, for us.
Let me ask you a question. Do you think we're going into recession? And how much does that really matter? Because the market just does not seem like it matters a whole lot.
I think that's I think that's the $1 million question. And I'm looking in the crystal ball here and I'm seeing a whole lot of nothing. So, unfortunately, I don't know if I have a great answer for you there. I mean, to your point, we are waiting to see what the final numbers will be, but we've talked about this too, right? How many months usually go by till you figure out that you actually have just gone through the recession? And historically, the market bottoms when you're actually in a recession. So, even if, Q1 does turn out to see real GDP shrink, and Q2 does the same. When are we actually going to find out about that? Sometime in Q4, probably at the earliest that we would actually see that. And at that point, the market's probably already going to have bottomed.
Well, the early indicator here has been the retailers, right? So I think it's you can get into this risk of looking at one individual retailer, like a Target, for example, saying, "Oh, Target's reporting massive sales declines," and you're like, "Oh no, the world's coming to an end." And then you look at Amazon, you look at
Walmart.
Walmart, which we're going to talk about. I pulled up Costco's numbers here, and you just don't see a recession at Costco. So net sales for the first 31 weeks of 2025. So this came out April 9th, 2025 this year. Net sales at Costco were 158 billion. Yes, that's with a B, and that's an 8.3% increase from 147 billion last year in 2024. So an
Yeah.
8.3% increase. I just don't see a recession at Costco. Do you?
No, I don't. I don't. I mean, we're moving, we're getting stuff for the house. So we're stopping there we're getting the chicken for dinner. We're picking up bed sheets. We got to get a new Ring doorbell camera. You got to get a TV. And the place is just packed out. You can barely move in there if you go at the wrong time. So I would agree with you there. I
Well,
don't
well,
think you see it.
what would it take to have a recession, right? What would it take to have Costco have a significant problem? I think that's the big question, right? What's the catalyst for us to go into back to the abyss of '08 and '09? I think it's people would seriously have to lose their jobs. Like you'd have to have
Yeah.
massive, massive all layoffs across all industries, blue collar, white collar, everybody. And if you saw massive layoffs, then I think you have a problem on your hands, and I think that's what the Fed tracks.
I would 100% agree with that. And I talked about this at the Wealth Insights Forum earlier in the month, where when you stack up unemployment and the Fed funds rate, generally seeing an uptick in unemployment is a leading indicator for when rate cuts are to come. We saw this happen last year. We talked about it with Siegel again, where at the beginning of last year, you started to see unemployment creep up. The Fed had their cuts towards the end of the year in preparation for that, but unemployment still 4.2% was the number last week, right? I think if you pay attention to that, that's definitely what they're looking at. They've got the mandate to CPI as well. That's gotten a little bit lower. It was what 2.4%, I think was the last reading. We'll get another reading next week on what April did. But I think they're going to stay tough and strong on keeping rates where they're at until you start to see pain in the labor markets, which we don't want to see, obviously, but that I think to your point is what they're paying the most attention to.
Well, what? Okay, so I think you're 100% right. What is the catalyst then to get layoffs to that point? Do you say, okay, corporate America, which first of all has not rushed to lay tons and tons of people off here, even with the uncertainty of tariffs. Okay,
Yeah.
so it's like you can listen to what people say on CNBC, but then look at what they're actually doing in their companies. I'm talking CEOs and management teams. Are
Yeah.
we rushing to do mass layoffs? Not really,
No.
right? Look at the largest S&P 500 companies. And I would question, does Microsoft really suffer from tariffs the same way a small business does, right? And I'm not saying this is a good thing, but that's the reality of it. Look at CrowdStrike. CrowdStrike CEO just went on a podcast. I watched him, and they said, look, there's zero tariffs on CrowdStrike. We do everything in the US.
Yeah.
We're cybersecurity. We are the last thing a company is going to cut if they have to cut spending. Cybersecurity is not going anywhere. Now, I'm not making an endorsement of CrowdStrike. I'm not saying you go buy it or sell it. But what I am saying is there are industries and companies who have been unaffected by what we're seeing and have companies really acted on what they said. You just don't see these mass layoffs that everybody thought was coming.
Well, I think you have seen over the last few years, right? You did a show, I think 2 years ago, layoffs are coming, and you did see that uptick
Hmm.
where it happened. And companies have tried to, I think, learn from mistakes in the past where as they've grown or felt like there might be rougher seas ahead, they've kind of preemptively started to lay people off. They also hired out of the wazoo, basically, coming out of COVID, some of them, like the tech companies, to increase their headcount rapidly, and then they just kind of had to scale things back. But you look at like an Amazon, they've done very strategic layoffs, getting rid of middle management, higher salaried people, which again, we're not saying that's a great thing, but from a company perspective, they're trying to prepare themselves if there was something to come. I know they've dropped their stock compensation just a little bit. So they're preparing themselves. They've got a massive cash pile as well. They're poised to kind of take advantage if there are stresses in the market, and they're not going to be as affected by them.
From a macroeconomic standpoint, we've got a new tax bill coming, right? And I think the tax bill can't come soon enough, right? Because I talked to my wife about this. She's on this Facebook group called Buy Nothing. I don't know if you've heard of that before. And once in a while, we'll put things on there that we just don't need, that we don't necessarily want to sell. We just want to, somebody else can have it essentially.
Yeah.
And she said that group is more active than it's ever been. And I think this goes back to the statement that Besant made, right? And he said, we've never had more Americans basically buying Ferraris and doing well than we've ever had, but we've also never had more Americans going on food stamps than we've ever had at this exact time. And it's such a weird environment where you have both of those things happening simultaneously. And that's what's really sad. I mean, you see this where, you go to the grocery store. We were talking about this off air, right? And you look at the prices to buy meat, to buy groceries, to buy healthy food. It's unbelievable what you can spend even at Walmart nowadays. I went to Walmart the other day to get some groceries for our party that we had for baby Jack, and I was $250 out the door for at Walmart,
Yeah.
And I'm looking at this and I'm going, how does a middle class family sustain this long term? And I think you're definitely starting to see some weakness there. If you're boots on the ground, you've seen this. But at the same time, you've got the top 10% of Americans that are still doing 50% or more of the spending, and that has been enough to keep this going. So I think that I go back to the tax cuts, and I say President Trump has floated the idea that anybody making under 150 grand a year pays zero tax. That would be the biggest round of stimulus this country has ever seen. And it's not unthinkable. Now, is it going to be 150 grand? Probably not. They're going to
No.
negotiate it. They're going to have to talk about it. But I think the next tax bill that's coming is going to be very, very favorable, especially for middle class. The reason I think that is because if the Democrats don't agree to that tax plan, they're going to be the people who said no to helping middle class families, and then they're going to have to go face the midterm elections. And there's absolutely no way they're not going to agree to this. And it's just like what happened to President Obama at the time, where he was forced into a better tax bill from a conservative standpoint than he really would have wanted otherwise. He wanted these aggressive tax hikes and all the rest of it. He wasn't able to get it done. So the best possible thing that can happen now, going into the midterms and going into 2026, when that new tax bill comes out, is we give some relief to low and middle class families.
Yeah, because we've really only had, and we've talked about this a lot, and a couple of the people that we follow have talked about it as well. When you look at Trump and the administration, what they've been doing, they've kind of done the hard stuff first, right? They're trying to get this out of the way while they can still, we've already seen it. He was blaming Joe Biden for giving him a garbage economy coming into it, right or wrong, whatever. This is the playbook, right? If you have weakness in the first, 6 months to a year, you can still try and blame the prior administration for what they've handed you. And then you can get some of the harder things out of the way, like the tariffs and some of these other policies that they've implemented. We haven't really gotten the good stuff yet that's actually going to stimulate the economy. So that's something to be watching out for. And then on the other side, too, obviously the deficit is still a big question. Do you think there's going to be enough saving in place where if we did kind of give tax break to some of these lower income families, that we'd be able to sustain government spending at that level?
No, no, I definitely don't. I mean, I think the reality is you are going to have to cut spending. And this is what people don't like to hear. This is the uncomfortable reality of a very bloated federal government. I mean, we've gone from a couple percentage points of GDP going to fund the federal government to literally 30+% funding the federal government. And that's a ridiculous, ridiculous amount. And so part of the reason you could end up in a recession too is if government spending continues to dip off like it did, it was down 0.5% this past quarter in the early estimate. That's a driver of GDP. Let's be real. And government spending does spur GDP growth in the short term. Now, in the long run, what it does is it does reduce innovation. It does reduce entrepreneurship. So how does President Trump get around that? I don't know. I don't know the answer to that. What I think he's leaning on is again, I'll go back to the tax bill. I think a very favorable tax bill because again, you put $7,500 back into a middle class family's pocket in tax relief.
Yeah.
What are they going to do with that money?
Spend it.
They're going to go spend it.
Well, it's just
Absolutely.
like the stimulus coming out of COVID,
Right.
right? That all got spent for the most part.
Right. So, you're having this COVID round trip. Now, Brian Westbury at First Trust has been basically bullish his entire career, right? He was bullish through '08 and '09. He kept people on their plans, did a great job. He went a little bit more bearish the past couple years after 2022. And I think the thing he was looking at the most was M2 money supply, number one, but then also the Fed balance sheet. And this is something we've covered in the past is the fact that you don't necessarily have to have Fed rate cuts or hikes to have any movement on interest rates. You could just have the Fed continue to shrink its balance sheet, which is a tightening move, which
Yep.
they've been doing right now. And
Yeah,
you
they're
could,
still at 40 billion a month. They were doing 60 a billion before that, and they were doing 100 billion coming out of COVID when they started actually implementing the tightening policy June of 2022.
right. And that's a major, major pressure on interest rates. That's why rates have not dropped. And that's why we said be careful with long-term bonds. I think the reason the Bears have been wrong, okay, I think is because M2 has actually it dipped down for a little bit, but it's actually ticked back up recently in the past couple quarters, and that has helped keep things not from completely falling apart. We went down 20% at the worst point. That's a recessionary indicator in the stock market. You don't get a 20% decline in the S&P unless you're about to head into a recession, even if it's mild, right? We're still down about 10% from the all-time high. But I think the reason we haven't gone into this '08 and '09 style abyss is because M2 has actually kept up. And you have to remember back to 2020, we printed over the past couple of years 45% more dollars in the economy. So Brian Westbury's point, which was I think well received, was at some point that 45% more money is going to burn off somewhere in the economy. And that just has not really happened. Households still are hanging on to some savings. And what's really interesting is you brought up Berkshire Hathaway with Warren Buffett sitting on 300, what is it, 370 billion in cash,
350, yeah.
350 in cash,
Yeah.
making 4% risk free. And there's a ton of households across the country that are doing the exact same thing, making more money than they ever have with record high interest rates.
Well, and that's part of it's kind of like the dichotomy. There's two different we have two different kind of class levels. It's almost like you've seen the lower middle class families have a harder time, and the rich families have been doing, or upper class families have been doing much better. And that's, I saw a chart this morning. Money market fund assets are up at 7.4 trillion dollars, and you've seen basically at COVID they were around 4 trillion. So you're looking roughly around a 40 to 45% increase in money market assets there, where again, if you've got a lot of money invested, you're just clipping it was 5% for a long time there. Now it's 4. It's like, why wouldn't I just keep getting free money, at least with some of my safer assets for the time being? I can live off that, no problem. It's what we do with our clients. So
Yeah, I think so Pew Research says the average middle class income is about 105,000. If you take a 4.2% interest rate on $100,000 in income, that's about $2.4 million that if you had that, you could literally have a middle class income without lifting a finger right now.
yeah.
That is the major. It's a very weird point of what's happened with COVID. It's like we printed all this money in the economy to try and stimulate things, right? And I think you could argue almost probably both of those bills were unneeded, President Trump and President Biden's bill.
But
But
definitely not Biden's.
definitely not Biden's. I mean,
Yeah.
they called it the Inflation Reduction Act, which was like such a ridiculous thing. It's like the 1984
Yeah.
Orwellian novel of, we're actually reducing inflation by increasing inflation. It's like what are you guys
How's
talking
that
about?
supposed to work?
Yeah.
Yeah.
Yeah, I'm not a
Uh,
mathematician here, but
this doesn't add up to me. Well, then they said it's transitory, and that's all worked out really well. So,
right.
let's finish up here talking earnings, because that's really really what's going to drive things forward, right? Market's a discounting mechanism. Maybe some of what we're seeing today, as far as the market going down, is anticipating what tariffs are going to do. Um, 72% of companies have reported earnings already. We're up 12.8% on a year-over-year basis for Q1. So great growth. Second consecutive quarter of double-digit percentage growth, but we'll see what the last 28%. Obviously, we got some big names in there that still need to report. What we're seeing, though, and maybe this is what's getting priced in, is analysts are cutting expectations for Q2 roughly 2.4% across the board right now. Do you see that kind of being a reason maybe the market's just hanging in this zone that it's in right now?
Well, look, I think if you run screens on the individual names, there is a massive, massive difference between companies that you'd want to buy right now versus the rest of the S&P. And to sit here and say, oh, the S&P is valued at 22 forward or 21 forward is not really doing yourself the benefit of looking at the individual names. And that's what we do at Stenger Family Office is we, obviously you're heavily involved in this. And, I run screens on the S&P. Okay. And I say Microsoft today is trading at 33 PE. You've got NVIDIA here at 38. You've got Google at 18. You've got Amazon at 30. You've got Meta at 23. And these are all companies that have grown sales 10% a year or more the past 5 years. If you screen the S&P by balance sheet quality, meaning not over levered and have grown profits and revenues over the past 5 years like this, there's literally only 78 companies out of 500 that fit the bill.
Yeah.
78. And again, I think this is the problem for people as they look at these analyst cuts, as they look at the entire S&P. Not every company's created equal. Not every company has the same balance sheet. Not every company has the same management team. Just because two companies are airlines, doesn't mean they're managed the same way. Just because two companies fit in the energy sector on XLE, the Spider ETF,
Yep.
doesn't mean they're both managed correctly or the same way. And I think this is where we've added a lot of value. I think this is where being very careful of the quality of companies that you own has really made a difference is by separating the best from the rest. And again, I don't know how you look at the S&P and say, I'd want to own all 500 companies forever. I mean, it's only 15% of the index is literally driving most of the quality. Okay. Now, you are paying a premium for high growth names that we've stayed away from, like Palantir. Now, right or wrong, maybe we should have bought Palantir. Maybe we shouldn't have.
Yeah, but that would have been more of a momentum trade. They still haven't proven that they're going to have earnings next year that justify it, right? What is it trading
Right.
at right now? Like a 700 PE or something like
About
that?
500.
Okay, 500. Sorry. Was a little overly aggressive with that one. But yeah, I mean, and I think if you see guys too, right, from a technical standpoint, when they're actually looking at the chart, we're more fundamental and is this a good business? And is it going to continue to be a good business?
Well, and you can have a run up in the short term. Think about Salesforce in May of 2020 to November of 2021. Salesforce ran up 72%. It was trading at a ridiculous multiple. I think at one point, Salesforce was trading at 1,800 times earnings. And the Dow Jones literally kicked ExxonMobil out at a all-time low, right? Like
Yep.
$28 a share, whatever it was trading at,
Yep.
and replaced it with Salesforce. And that's why I think there is a component to actually using critical thinking, common sense in the portfolio of guys, should we really be paying 1,800 times for a company and selling a company that's trading for record all-time cheap prices? Right now, there was a question as to whether or not ExxonMobil was going to come back from the lows, and they were paying to hold oil on the balance sheet. That was pretty scary. But at the same time, I think that's where companies are groups like us can add some value. I would just also throw in a couple other examples we've talked about on the show. Now, we haven't bought this for clients because it doesn't fit the size category in the portfolio, but Casey's, we did the Casey's pizza test. I will say Casey's pizza is not bad. I know that's as a shock to everybody, but
Our standards are actually really low.
no, we actually have very good standards here in
Yeah.
Chicago, but for $1.99, that's not a bad slice of
Yeah,
pizza.
we've picked up a couple slices before trips and everything like that. Maybe
Right.
not our smartest decisions, but it at least tastes good going down. So,
Casey's is up
um,
18% this year. It's up 43% the past 12 months, and it's up 206% the past 5 years.
yeah,
A general store, a gas station.
yeah.
So again, if you know what you're buying and you can look with a critical lens at the companies you're owning, there's money to be made in any market. This environment, tariffs, not tariffs, whatever environment you're in, my point is you can make money.
Yeah. And I think that's a good place to end it, unless you had any other thoughts you wanted to throw in. All
All
right,
good.
fantastic. Thank you for your thoughts, sir. Thank you, everyone, for listening. Again, make sure you like, subscribe, share the show. If you haven't already, mark the calendars, October 16th and 17th. We'd love to see you at Investor Day 2026. So hope you have a great rest of your week.